Hello, everyone. Don Garman here yet again. Here we are, May of 2024. Another month has come and gone. I will first say happy early Mother's Day to all of you mothers out there. And thank you all for everything that you do for all of us. You are a force of nature, and we are deeply appreciative. Hope you have a great weekend and you are spoiled by your families. And without further ado, I will move into a brief discussion this week of markets and sentiment and earnings, which is obviously my favorite topic every month. Um, it's a very interesting period. We have gotten through certainly the bulk of earnings season, which happens every quarter. At the beginning of the quarter, we report the last quarter's results. We're now Last week was the busiest week of earnings season. We are through all of the unregulated monopoly tech businesses, which went largely our way, and which we're grateful for. And the businesses themselves seem to be doing great and kicking off monstrous amounts of cash, which they use to buy back their stock, which is generally good for the rest of us who continue to own positions that we've owned for a long time. The mystery around the current period is we have been talking about the forward level of earnings expectations, which generally signal, can signal periods of unease. And I think it's always interesting to look back 2 years ago at this time. People's expectations for 2024 earnings for this year was about $270. And the value of the index is a little over 5,000 now. So those two things have a relationship. And without getting any further into the weeds, the expectation now for this year's earnings is down to about $240. So we've talked about it before. Earnings for 2 years ago ended up coming in at about 214. Earnings for last year ended up coming in at about 218. The question will be, are we going to see $240 of earnings, or are we once again going to have a very slow earnings growth year? If we do, it seems a little, it seems inappropriate to be paying 24 times as the multiple for this lackluster level of earnings growth. And really, the earnings growth has really just come from a couple of places. So the hope, and I think what the market is expecting, is that the $240 will be evidenced looking back on this year from next year, and in fact start growing again. That would be the only justification for paying the general prices that we're seemingly willing to pay now. So one of two things will happen. Either we will, and this quarter was the opportunity to start to talk down the next 6 months, which really wasn't seen on a broad level. So as we get into spring and into summer, if there is starting to be some evidence of the job market cooling, if that moves more into the concern that unemployment starts rising and people start throwing around the R word for recession, things will get more interesting in terms of more uncomfortable for the value of assets from where they are. So that's what I'll certainly be looking for in the next 6 weeks or 2 months. But beyond that, at this point, I'm grateful that we've had a relatively smooth return back to where we were after the April lull, following a great Q1. So, some of this marking time is natural and it's to be expected, and it's certainly more pleasant than going down back up to be in the same spot. So we're going to continue to monitor everything as we always do, and certainly like what we're seeing, and a lot of our positioning seems very right, judged by a lot of different things. So I'll leave it at that. Happy Mother's Day. And once again, if you need anything, you know how to reach us. We're always available, and look forward to talking to you again next month, if not sooner. Thanks. Bye.